charge and what is the basic understanding? What is the basic understanding and fundamentals, and what are the possible issues which can crop up while we are implementing or doing this for our clients? So these are some of the questions which I have framed, and we would be discussing around these questions that what would be the possible implications. So first, the very basic question: how does the mechanics work between distinct person for input services and output services? See, I have tried to distinguish it in two parts for the ease of understanding. Scenarios for receipt of services in case of a multi-state entity. What are the different scenarios wherein a multi-state entity receives various invoices? So, in my opinion, there are three broad scenarios wherein a multi-state entity receives the invoices. First is receipt of invoices towards services received at the respective office. That is the services which are being received by the office itself. They are receiving the invoices for those services. So there is no issue about those services, because since the service is being received by me, the invoice will also be received by me. The second is the receipt of invoices towards services received at other office. Now I am registered at, say, West Bengal. My office is at Rajasthan. So the services are being received at Rajasthan, but the invoice is being received at the head office. So this is the second category of invoices. The third is receipt of common invoice services received both at both the offices. That is, services which are being received both at West Bengal and Rajasthan office. So there would be a common invoice for the services being received. What can be possible scenarios? Let's take an example that a consultant has been appointed to analyze the entire process of manufacturing being carried out at West Bengal and also at Rajasthan, that how the efficiency can be improved. So he is visiting both the offices, he is preparing a report, and a common report for both the offices will be submitted to the head office. Now, this is the scenario of the third category, wherein a common invoice is being received for the services which are being received not only at head office but at the branch office. Now, these are the three scenarios. Now, coming the three scenarios for receipt of the services. Now, coming to the second aspect of scenarios for provision of output services in case of a multi-state entities. What are the different scenarios in case of an output services? Like we have discussed in the case of input services. Now, let's try to decipher what are the various scenarios for output services, because these scenarios only form the basic fundamental for ISD and cross charge. Now, here also there are three scenarios. First, I am in office, I provide a service to my customer, I raise an invoice. This is the basic scenario wherein I am raising the invoice for the services provided by me to my client. Now, let's take another example. Supposedly, I have a head office at West Bengal, branch office at Rajasthan. My branch office has received a contract which they are executing. Now, my branch office has sought a help from the head office that please send a staff from the head office so that the service can be provided, because we alone cannot provide and execute that contract. So, in this case, the head office is providing services to the branch office, and branch office, together with the services being provided by the head office, is providing services to the client, and they are raising the branch office is raising the invoice to the customer. So the end invoice is being raised by the branch office to the customer. So what the head office would be doing? They would be raising an invoice to the branch office for the services which they have provided to the branch office. Now, coming to the third scenario. In this case, there are certain centralized services, which we can say centralized support services, which are being provided by the head office to the branch office. Now, these are the broad three scenarios in case of provision of output services in case of a multi-state entity. Now, how does ISD and cross charge fits into this two broad aspect? So, in case of a receipt of service, which we initially discussed, that receipt of invoice for the services provided at another office, or receipt of a common invoice for the services provided at both the offices. These are nothing but bought out services. The services for which invoice has been received, no counter service has been provided by the head office to the branch office, but the services are being directly provided to the branch office. This is what we can say as a concept of a bought out service. In case of output service, out of the three scenarios, the second scenario and the third scenario, this we can refer as an internally generated service which the head office is providing to the branch office. Why we are discussing about a bought out service and a internally generated service? Because the circular which was issued in July 2023 classified the scenarios broadly into two aspects. One is a bought out service and second is a internally generated service. So the scenarios which would be falling within the aspect of bought out services, they would be covered by ISD, and the scenarios which would be falling within the aspect of internally generated service, they would be falling within the ambit of cross charge. So this is the broad concept of ISG and cross charge and how we can understand it simply on a fundamental basis, that how we have to identify what is fitting into a bought out service, what is fitting into a cross charge, internally generated service, because on bought out services, I would be raising an ISG invoice, and for cross charge service cases, I would be raising a normal supply invoice to my branch. So we have covered the first question, what is the mechanics which works between a distinct person for input and output services. Now coming to the second basic question, what is a ISD? Now keeping in the background what we have discussed about the bought out services, now linking it with the definition of input service distributor. See, there are three definitions for input service distributor in three different eras. The first era is prior to the amendment of Finance Act 2024. The second is after the amendment of Finance Act 2024, but prior to the amendment of Finance Act 2025. And the third is post amendment by Finance Act 2025. Why these three definitions? Because these three definitions in three different eras would help us understanding that how the mechanics of ISG has changed. So in the first aspect, prior to Finance Act 2024, there were two conditions. I would not be discussing the entire definition, but two conditions which were forming the basic of who is an input service distributor. The first condition is, which remains as on today also, that the office should have received tax invoices under Section 31 towards receipt of input services on behalf of any other office having based on the same permanent number. So an office who is receiving a tax invoice under Section 31 for another office who is on the same permanent account number. This was the first condition. This condition more or less remains the same in two scenarios, post Finance Act 2024 and post Finance Act 2025. The only change is, previously there was a reference to invoice under Section 31. Now they have referred only to tax invoices. The second and the most important change, prior to Finance Act 2024, there were two conditions. First, we have already discussed. And the second condition, only upon which, if it is fulfilled, the person would be covered under input service distributor. And the second condition was, not only they should have received an invoice under Section 31 for another office, but they should have also issued a prescribed document. That means not only receipt of service, but issuance of a prescribed document was also necessary for a person to fall under input service distributor. So what if a person has received services but not issued the document for distribution of credit? Then in such case, the person would not be falling within the scope of input service distributor. So therefore, prior to Finance Act 2024, by virtue of this definition, ISG was optional. Because if I am not issuing a prescribed document for distribution of credit, I was not falling under ISG. And since I was not falling under ISG, provisions of ISD were optional for me. But post Finance Act 2024, although this amendment is only effective from 1st of April 2025, now the condition of and issuing a prescribed document has been replaced by and liable to distribute the input tax credit. Therefore, now if a person who has received an invoice for another office, he is liable to distribute the credit in respect of such invoice in the manner provided under Section 20. So now a thing which was optional only upon issuance of invoice, now it has become mandatory because they have changed it to liable to distribute rather than issuing a prescribed document. And secondly, they have also covered within the aspect of ISD distribution of credit on which tax is liable to be paid under RCM under Section 9.3 and 9.4. So, by way of Finance Act 2024, only RCM, which was liable to be paid under Section 9.3 and 9.4, this was included under Input Service Distributor. So, two major amendments. First, it became mandatory to distribute the input tax credit for invoices received for another office. Second, payment of tax under RCM, the input tax credit related to that payment of RCM was also liable to be distributed. Thereafter, the lawmakers came to know that they have only inserted Section 9.3 and 9.4. So, by way of Finance Act 2025, they further amended this definition and also included payment of tax under RCM on interstate supplies by way of Section 5.3 and 5.4 of IGST Act. Now, interestingly, this amendment, although Section 121, which is a relevant section of Finance Act 2025, it provides that this amendment of inclusion of interstate supply shall be effective from 1st of April 2025. But Section 2 of Finance Act 2025 provides that Section 121 shall come into force on such date as central government may by notification in official gazette appoint. This notification of putting into force Section 121 has not yet been issued. So although Section 121 in itself provides that the provision would be effective from 1st of April 2025, but since the notification to put it into force has not been issued, therefore this definition of inclusion of interstate supplies on which tax has been paid under RCM for distribution of credit is not yet effective in the definition of input service distributor. On a similar parallel understanding, if we go through Section 125 of Finance Act 2025, which amends Section 20, on a similar line, that Section 125 of Finance Act 2025, by virtue of Section 2, Clause A of Finance Act 2025, has been made effective from 1st of April 2025. Because Section 2, Clause A of Finance Act 2025 provides that Section 135 shall come into force on 1st day of April 2025. Whereas for Section 121, Section 2 Clause B provided, Section 121 shall come into force on such date as central government may by notification in the official gazette appoint. So on an entire reading of Section 2 of Finance Act 2025, Section 121 of Finance Act 2025 and Section 125 of Finance Act 2025, the definition, the amendment which has been made by Finance Act 2025 include inward supply on which tax is to be paid under Section 5.3 and 5.4 of IGST Act for the purpose of distribution of credit is not yet effective. As and when the effect, this notification is brought into force for making Section 121 effective, it would be effective from 1st of April 2025. So supposedly, government comes and issue the notification on say 1st of May 2025 to provide that the notification shall come into the Section 121 shall come into force from on 1st April 25, 1st May 2025. The impact would be a retrospective amendment because the section itself provides that this amendment would be effective from 1st of April 2025. But unless and until that notification is issued, this amendment is still dormant. It is not into effect till now. So input service distributor, on a broad understanding, the definition which stands as on today is an office which receives invoices toward receipt of input services. Those input services which have been received at another office, the office receiving such invoices would be liable to distribute the credit in respect of such services to the office who has actually received the service and in the manner which has been provided under section 20. So now the option has become a mandatory distribution of credit, and this is the definition and scope of ISD. What we have discussed in ISD can be easily related to the concept of bought out services. Now coming to the next aspect of what is a cross charge. Cross charge is nothing but what we have discussed as a concept of internally generated services. One, wherein the head office is supporting and providing service directly to the branch office for execution of a contract. Secondly, centralized support services like accounting, which are being provided by the head office to the branch office. These are internally generated services. Now, what's the big difference between a ISD and a cross charge? See, if we go through the agenda of the GST Council meeting, which was held in June 2023, it themselves referred to this concept of internally generated service and bought out services. For internally generated service, the relevant provisions which are applicable are Section 2, Clause 61, that is the definition of input service distributor. Read with Section 20, which is the charging section for distribution of credit as an input service distributor. But in case I have interchanged, for an internally generated service, the relevant provision would be Section 7, read with Para 2 of Schedule 1 of and Rule 28. And for bought out service, it would be Section 2, Clause 61, read with Section 20 of CGST Act. So for bought out service, concept of ISD applicable, relevant provision, Section 2, Clause 61, definition of ISD, and Section 20 of CGST Act. For an internally generated service, the relevant provision would be Section 7, that is the scope of supply. Para 2 of Schedule 1, that is supply of services between two related persons or distinct persons. Read with Rule 28, which provides for valuation of services between two distinct persons. Now coming to the big question, cross charge versus ISD. Now, since we have discussed the basic fundamental, what we are required to do, the first thing which we are required to do is to identify whether the invoice which has been received by a particular office, it is pertaining to the services which has been received by that particular office. If yes, then it is a clear case of an input tax credit pertaining to that office only. Second, if that invoice is related to the services which have been received at another office, then it becomes a bought out service covered in the purview of ISD. Third, it is pertaining to service which have been received commonly both at the head office and at another office or at multiple offices. Again, it becomes a case of an input service distributor, that is a bought out service. This is the scope of ISD. Now for cross charge, see, the basic theme of cross charge is that I am providing some services. When I receive, supposedly I receive an invoice of insurance, which has been carried out, which has been done for a building of a branch office. So my building of a branch office has been insured, but the invoice has been received at a head office. In this case, I am not providing an output service of insurance to my branch office. So this would be covered as a bought out service. On the contrary, if I am doing an accounting service for my branch office, therein I am providing an output service to my branch office. This is an internally generated service. This is not a service for which only invoice has been received by me, but a third party has provided a service to the branch office. This is a case wherein I am myself as a head office providing a service to my branch office. So this is a case of internally generated service wherein I am required to issue an invoice. So what if I do not issue an invoice? In that case, the department would refer to section 7, schedule 1 para 2, read with rule 28. For section 7, reference to section 7, yes, section 7 is applicable because I am providing a service to a distinct person. Why section 7 would be applicable? Because by way of para 2 of schedule 1. What would be the valuation? Therein rule 28 would come into operation because rule 28 says if my recipient is eligible for the entire credit of that internally generated service invoice, whatever valuation I have put, that valuation would be accepted. But if my recipient is not entitled to the entire credit, supposedly my recipient is providing some taxable services and some exempt service, then proper valuation as per rule 28, that what would have been the valuation in case such services were being provided to a third party, that would be applicable. So in case of cross charge, section 7, para 2, schedule 1 and rule 28 would be applicable. And in case of ISG, what would be the relevant provisions? Section 2, clause 61, which defines input service distributor, and section 20, which provides the process that how the credit has to be distributed. So whenever I am now take a practical example that while you are preparing a return for say month of April 2025, because from 1st of April 2025, this concept of ISG has become mandatory. The first thing which would be required to be seen, what are the services for which credit is being taken? Whether those services have been received at the relevant office or at some other office. If yes, then the client should have been advised to take the ISG and take the invoice in the registration number of ISG. Because this credit is liable to be distributed by way of mechanism of ISD. Now the head office or the such office who is receiving the invoice for services being received at some other office, they cannot just simply claim the credit. Because as per definition and as per provision of section 20, they are liable to distribute this credit. The second aspect, what are the services for which credit has been taken, wherein the service has been received at multiple offices? In that case also, the client should have been advised to take ISD registration and mention the GSTIN of the ISD. So now the things have changed. This is the basic difference of a ISD and cross charge. Now coming to the next question, what is the change of scenario in ISD pre and post 1st April 2025? Yes, we have discussed how invoices have to be seen, how the credit is to be distributed, how internally generated services have to be seen, and how the invoice has to be raised. But what is the change pre 1st of April 2025 and post 1st of April 2025? This has been discussed, and this is the final decision which was taken by the Law Committee in the 50th GST Council meeting, wherein looking to the definition which was there at present for input service distributor, Law Committee took a view that ISD procedure as laid down in section 20 of CGST Act Read with Rule 39 of CGST rules. We made mandatory prospectively for distribution of ITC in respect of input services procured by head office from a third party but attributable to both head office and branch office or exclusively to one or more branch office. So they themselves admitted that this provision for mandatory distribution can be only made mandatory prospectively and not retrospectively, because prior to the amendment which has been made by Finance Act 2024, the concept of ISD was optional. Now, let's take a scenario and let's try to analyze how the things were being dealt prior to 1st April 2025 and how the same things would be dealt post 1st of April 2025. Let's take an example that a building at branch office has been insured. The head office received that invoice. Now, once that invoice was received, first, whether head office was liable to distribute that credit to the branch office? No. Why? Because ISD was not mandatory at that time. Secondly, would head office issue an invoice to the branch office for a cross-charge invoice raising that we have provided a service of insurance to you and this is the credit which is pertaining to you? Yes, they could have done that. Because at that time, prior to 1st of April 2025, both the options were open. The third scenario, supposedly the head office has not issued any such invoice of cross-charge. Then what would have happened? Then in such case, the circular 17th July 2023 comes into picture, wherein they have said that if such credit of bought out services were neither distributed through ISD nor transferred by way of issuing of cross-charge invoice, in such case, if the recipient was entitled for 100% credit, which would have been passed on by the head office to branch office, even if the head office had not issued any invoice, it would be treated that an invoice at nil value has been issued. And in such case, no contravention of law would be seen on part of head office. But if the recipient was not entitled to 100% credit, then the head office would be treated as contravention of the provisions for not issuance of a cross-charge invoice. So simply, prior to 1st of April 2025, what was to be seen? In case of bought out services, whether ISD taken? No, no issue. Whether such credit transferred through cross-charge invoice? No, still not an issue. Whether the recipient is entitled to claim of credit, 100% credit? Yes, then it would be deemed that an invoice has been issued at nil value. But if the recipient is not entitled for 100% credit, then there would have been a contravention for non-issuance of invoice by head office to branch office, because they would have treated it as a holding of ineligible credit by the head office. Post 1st of April 2025, for similar situation which we have discussed, if the head office does not issue a ISD invoice and transfers the credit to the branch office, there would be violation of Section 20 of CGST Act. The head office does not have an option of transferring such credit through a cross-charge invoice. Because post 1st of April 25, since ISD has been made mandatory and the office is liable to distribute the credit to the other office receiving that service, ISD invoice has to be mandatorily issued. There is no such option for issuance of a cross-charge invoice. So therefore, this is the change of scenario which has taken place prior to 1st April 2025 and post 1st of April 2025 in case of a bought out services. Coming to the next question. Is ISD an attempt to identify the recipient within a recipient? See, if we go through the definition of recipient and clause 2 in section 2, clause 93, recipient of a supply of service is where a consideration is payable for the supply of services of both the person who is liable to pay that consideration. So, what the statute says that irrespective of the fact whoever has received the service, in cases where consideration is liable to be paid for those services, the recipient would be the person who is liable to pay the consideration, irrespective of the fact that who has received the supply. Because in clause C, they have said that where no consideration is payable for supply of service, the person to whom the services is rendered is the recipient. So the lawmakers were very well aware that when in condition where consideration is payable, they are not treating the person who has actually received the service as a recipient. They are treating the person who is liable to pay the consideration as a recipient. So, by way of section 2, clause 93 of CGST Act, I am first identifying the recipient. Why I am identifying the recipient? Because place of supply of service for section 12 and section 13 of IGST Act specifically requires me to identify whether the location of supplier and recipient are within the country or whether the location of supplier or recipient is one of them is outside the country. So while identifying the place of supply, I am identifying who is the recipient as per section 2 clause 93. And based upon identification of that recipient, my place of supply has also been identified. And based upon that, the supplier has issued the invoice to the recipient as per clause 293, read with section 12 or section 13 of the IGST Act. Now, what Rule 39(1) requires me to do? They say that credit of tax paid on input service attributable to a recipient of credit shall be distributed only to that recipient. So once a recipient for a supply has been identified, place of supply has been identified, invoice has been issued to that recipient, treating him as a recipient of that service, Section 20, read with Rule 39(1) requires me to transfer that credit to another recipient, which they feel that has actually received the service. Now, again, coming back to the definition of recipient of service in Section 2, Clause 93, it provides that at the end that any reference to whom a supply is made shall be construed as reference to the recipient of the supply and shall include an agent acting as such on behalf of the recipient in relation to the goods or service of both supplied. So this section 2 clause 93 has said that once a recipient has been identified, any reference to a person to whom a supply is made shall be deemed to be referred to this recipient only. So in my opinion, when I identify a recipient in section 2 clause 93 for place of supply, and that place of supply is identified based upon section 12 and section 13 of IGST Act, and the supplier issues an invoice to the recipient. By way of section 20, read with Rule 39(1), the lawmakers are trying to identify a recipient within a recipient. They would have simply, if that would have been the intent, they should have also amended section 12 and section 13 of IGST Act. And therein they should have provided that this is the place of supply wherein the services are being received by any other person, but the invoice is being received by some other person. This is an additional compliance which goes beyond Section 2, Clause 93, CGST Act, and Section 1112. And in my opinion, this is nothing but identifying of a recipient within a recipient. Now, coming to the next question, what is the time limit to distribute credit by ISD and whether it is mandatory or recommended? Now, what is the time limit to distribute the credit by ISD? Now, for this, we see Section 20, Clause 2, which says that the credit shall be distributed in such manner, within such time, and subject to such restriction and condition as may prescribe. So the power to decide the time has been delegated by way of Section 20, subsection. Now, what Section 39(1)(a) says for distribution of credit? It says that the input tax credit available for distribution in a month shall be distributed in the same month. That means whatever is available for me to distribute shall be distributed in the same month. And the details shall be furnished in Form GSTR 6 in accordance with the provisions of Chapter 8 of these rules. So let's take an example. For April 2025, my supplier has raised an invoice to ISD. He files his GSTR1 on 11th of May 2025. Those details gets auto-populated to me on 12th of April 2025. By 13th of gets auto-populated on 12th of May 2025. Prior to that, I cannot distribute because the details would only be available on 12th of May 2025. I would be required to distribute in the same month. That means I have to distribute it in the return for the same month which has been filed for April 2025. So I would have to file that return by 13th of May 2025 so that my recipient gets the credit. If I do not file by 13th of May 2025, my recipient gets the credit in the same month. But if I do not distribute that credit in the return for the same month, that is April 2025, by mistake, say I file a nil return. That means there is a contravention of Rule 39(1)(a), read with Section 20, and my officer of the recipient can deny the credit that this credit was not distributed in the same month in which it was available. So this is a very harsh condition which has been provided under Section 20, subsection 2, read with Rule 39(1)(a), that the credit has to be distributed in the same month. And for that, ideally, I only have 1 day. If I intend that my recipient should get the credit before filing of 3B of April 2025, I have many days. If I intend that the credit may be deferred, but if I do not report the credit and distribute the credit in the return for the month of April 2025, there might be litigation awaiting for me and for my recipient that the credit was not distributed in the same month in which it was available. Now the next, how input tax credit pertaining to reverse charge will be distributed. Now this is again an interesting aspect. We have discussed in the definition of input service distributor that post Finance Act 2024, which has been made effective from 1st of April 2025, an input service distributor is liable to distribute the credit on intrastate supplies on which tax is liable to be paid under RC. For simplicity, we are restricting it to this. We will then come to amendment made by Finance Act 2025. So ideally, what should have they done? Supposedly, I am an ISD. I receive a service of, say, advocate who is fighting a case which has a repercussion on, say, 5 of the branches situated across the country. So what should have they done? The advocate should ideally have raised an invoice on the input service distributor. Input service distributor would have paid the tax under RCM, availed the credit, and distributed it to the respective offices to which it pertained. But somehow or the other, they do not want that the ISD should pay that RCM by way of cash. For reason they better know, because when ISD can pay late fees through cash, what was stopping them in enabling the input service distributor to pay tax under RCM and then distribute the credit? But they did not keep it that simple. What they said, that in such cases, the regular registration of the same state would receive the invoice of the advocate the regular registration would pay tax under RCM of the same state. Keep in mind, in the same state wherein the ISD is registered. So the regular office of that state, supposedly ISD registered in West Bengal. So the regular registration in West Bengal would receive the invoice of the advocate, pay the tax under RCM, and then raise an invoice under Rule 54(1) capital A to the ISD registration. ISD registration then receive the credit and then distribute it to all the branches. So tax has to be paid under RCM by the regular registration. They have to report in their GSTR1. That would be auto-populated for the ISD, and then ISD would be transferring the credit. Now let's take an example. Supposedly, there are two branches. One is situated in Rajasthan. Second is situated in, say, West Bengal. And ISD registration has been taken in West Bengal. The branch office at Rajasthan receives the invoice of the advocate. Advocate is fighting the case which would be having a pan-India repercussion both on the branch office and the head office at West Bengal. So the branch office at Rajasthan receives the invoice. It pays the tax under RCM on that. Now, since there is no ISD registration in Rajasthan and ISD is registered in another state in West Bengal, branch at Rajasthan cannot issue an invoice under Rule 54(1)A to transfer that credit. Because the condition in Rule 39(1)A is the registered person who is issuing the invoice under Rule 54(1)A should be having the same PAN and the same state code. So in this case, RCM would be paid by the branch office at Rajasthan. But since it is a common credit, so firstly, it would not be eligible to claim that credit. Secondly, since no ISD registration has been taken in the state of Rajasthan, so no Rule 54(1) capital A invoice would be issued. So the entire credit gets blocked. So what is the option available in such cases? Either either ISD registration should also be taken in the state of Rajasthan, so that branch in Rajasthan pays the tax under RCM, issue the invoice under 54(1)A to the ISD in Rajasthan, and then ISD distributes the credit to the head office. Or the advocate should be advised to raise the invoice directly to West Bengal. The head office at West Bengal pays the tax under RCM, issues an invoice under Rule 54(1) capital A to the branch office, to the ISD registration, and then the ISD registration distributes the credit both to the head office and the branch office. So in cases of multi-state entities wherein multiple registrations are there, but only one ISG registration has been taken, it would have to be ensured that all such RCM invoices are being received in the state wherein the ISG is also registered and regular registration is also there. So this is one big impact of Rule 39(1)(a), and not only Rule 39(1)(a), it is coming from Section 20, subsection 2, because it says that the distribution of credit in respect of services subject to levy under levy of tax under subsection 3 or subsection 4 of section 9 paid by a distinct person registered in the same state as the said of the input service distributor. So RCM has to be paid by the person who is registered in the same state as that of the input service distributor for the same to be eligible to be distributed. If that is not done, and RCM is paid by a registered person who is registered in another state, and in that state there is no ISG registration, RCM would be paid, but credit could not be availed, either by the branch office or by the head office. Can it be said that a cross-charge invoice can be raised? No, because branch office cannot provide a legal service to the head office. It is a third-party service which is being received by the branch office on behalf of, together with the head office. It cannot be an internally generated service because the third party has rendered the legal services. That's why a distinction between a bought-out service and an internally generated service has to be made. Post 1st of April 2025. So this is one aspect of distribution of credit in respect of invoices on which RCM is payable under section 9(3) and 9(4). Now, amendment through Finance Act 2025, since RCM to be paid under section 5(3) and 5(4) have also been incorporated. The process for distribution remains the same. That regular registration should be, who is paying the RCM should be in the same state that of the input service distributor. But again, this amendment is yet to be notified, together with the fact that Rule 39(1)(a) also does not provide as on date reference to section 5(3) and 5(4) of IGST Act. It only provides reference to 9(3) and 9(4) of CGST Act. So not only definition in section 2 clause 61 is yet to be amended. This Rule 39(1)(a) is also yet to be amended. Only amendment which has been made effective in respect of interstate supplies on which tax is required to be paid is section 20 subsection 1 and 20 subsection 2. Rest of the two amendments are yet to be made. When they would be made, they're not known. So what has to be done by the taxpayer? It is something which has to be done on a decided on an individual level. However, on a safer side, because litigation is always borne by the taxpayer, even though amendment has not been made, on the safer side, comply with the provisions, we can pay the RCM on the interstate supplies also and distribute the credit through 39(1)(a), because as and when the amendment would be brought, it would be brought from retrospective date of 1st of April 2025. Although if compliance had not been made, supposedly, the taxpayer can take the benefit that this amendment and amendment to Rule 39(1)(a) was not made effective from 1st of April 2025. What happens to the credit pertaining to inward supply liable for RCM that we have discussed? What is the impact of Rule 54(1)(a) for distribution of credit pertaining to RCM that we have discussed? How credit of IGST, CGST, and SGST will be distributed? So supposedly, I am a ISG distributor. I receive invoices of IGST. That credit of IGST has always to be distributed as IGST to my recipient, whether it is situated within the state or outside the state. It is not a case that I receive a credit in IGST, but my recipient is situated within the state. So I would be distributing credit of CRS. I would be distributing credit of IGST only. But if I have received a credit of CGST and SGST, if my recipient is situated in the same state, I would be distributing as C and S. But if my recipient is situated outside the state, I would be distributing as IGST. Next, is credit separately to be distributed for eligible and ineligible credit? Yes, it has to be separately distributed. Now, an interesting aspect which comes to the question is, supposedly I'm a person who is exclusively dealing in exempted supplies. My branch office is also exclusively dealing in exempted supplies. I have received an invoice for which I am not eligible to claim the credit. Say a 17.5 invoice. Now that invoice is for receipt of service both at this office and my branch office. What we do at present is we claim this credit and reverse in row 4B1 as a permanent reversal. Since I have not taken any credit, I just take it and reverse it. It does not become part of my credit ledger. Now, what Section 20, Rule 39 and Section 2, Clause 61 makes it mandatory that since this invoice was pertaining to another branch office also, because it is nowhere linking or restricting applicability of this transaction only to cases wherein ITC has been availed. It only says that wherein the tax invoices has been received for services attributable to another distinct person. It is not saying about whether the credit has been availed or reversed. So therefore, in taking a strict interpretation, what has been mentioned in the law, I am a person who is exclusively dealing in exempted supplies. I have a branch office who is exclusively dealing in exempted supplies. We receive a 17.5 invoice which pertains to both the offices. I do not intend to claim the credit, but still I would be required to take a registration in ISD and I would be required to distribute the credit in the manner prescribed under Section 20, read with Rule 39, both the offices, and both the offices would then be reversing the credit. So ultimately, at the taxpayer level, there is no impact. But at the individual state revenue, there is a huge impact. Because what I was doing prior to 1st of April 2025, the entire revenue was being received by the head office, by the state wherein the head office was situated. But now the revenue is being distributed to two offices because these two persons, since they are not eligible to claim the credit, would be treated as a B2C supply for the purpose of distribution revenue between the states. So in my opinion, what has been done by 1st of April 2025 is it would not be giving benefit to any of the taxpayers. It is only ensuring that the states get their revenue. And for this aspect, this concept of ISD has been made mandatory so that in case of credit which is attributable to such supplies which gets consumed in a particular state, that state gets the revenue. How distribution of credit will take place in case of a single recipient, multiple recipient, or all distinct persons are recipient. This is a calculation based thing and we all are aware of this. So only broadly discussing this aspect, wherein the credit is pertaining to a single recipient, a ISD invoice would be required to be issued directly to that recipient. Secondly, wherein supposedly the credit is pertaining to two or more than two recipients, then in such case, the credit would be distributed in the ratio of the respective turnover of the branches. What would be the turnover? The turnover would be of the immediate financial year if both the branches or all the intended recipients have the turnover in the preceding financial year. Supposedly, one of the recipient does not have a turnover in the previous financial year. Then in such case, the relevant quarter wherein all the recipients had the turnover would be the turnover for the purpose of distribution of credit. So supposedly I am say distributing a credit of April 2025. Ideally, I would be taking turnover of 2024-25. Supposedly, one of the recipient do not have a turnover in 24-25. I would be taking the turnover of the last quarter, wherein both of the recipients of all the recipients had a turnover. So this is how the credit has to be distributed between multiple recipients or all distinct recipients. How input tax credit is to be reduced upon issuance of credit note? Supposedly, I have two branches. I have distributed the credit in 60:40 ratio. Thereafter, for the credit which was distributed, I receive a credit note. That credit note would again be distributed in the ratio of 60:40 between the two branches. It is not that the credit note will be distributed in the ratio of present month. It would be distributed in the ratio which was applicable in the month in which the original credit was distributed. Supposedly, there is no credit to be distributed to the recipient and there is a negative balance. Then in such case, the rule provides that such reversal would be added to the output liability of the recipient. How it would be added to the output liability, that is not known. That it seems some internal arrangement would be required to be made between the branch office and head office. And that credit which is liable to be reversed on account of credit note is to be added to the output liability. How the input tax credit is to be distributed upon issuance of a debit note? Suppose I have received a debit note. Then in such case, an input service distributor is not entitled to issue a ISD debit note. He would have to issue an invoice and that invoice would be distributed amongst the recipients. Last, how recovery has to be made for credit wrongly distributed. Now, this is one interesting aspect which I would like to discuss with all the participants and have the views of the participants, not only in this aspect, but all the other things which we have discussed. See, what is the definition of input tax? Input tax means input tax in relation to a registered person means central tax, state tax, integrated tax or UGST charged on any supply of goods or services both made to him and includes IGST on import of goods, tax payable under RCM under 9394, 53 and 54 and respective UGST and state tax. So amount which is charged on any supply of goods or services made to me is an input tax. Section 16 subsection 1 says that every registered person shall subject to such condition restriction as may be prescribed and in the manner specified in section 49 be entitled to take credit of input tax charged on any supply of goods or services both to him. That means there should be an inward supply made to me. That is covered under section 16 subsection 1. And that is how section 16(2) has also been worded. Notwithstanding anything contained in this section, no registered person shall be entitled to the credit of any input tax rate in respect of any supply of goods or services or both made to him. Why I am emphasizing on these three aspects? Definition of input tax, section 16 subsection 1 and 16(2). All these three scenarios are covering the tax which has been charged to me on the supplies made to me. Now the question is, when ISD is raising an invoice to me, whether it is a tax or an invoice pertaining to supply made to me, it is not a tax pertaining, it is not a tax pertaining to supply made to me, nor it is an invoice for a supply made to me. It is an invoice for distribution of the credit. It is not a tax on supply made to me. It is a tax, it is an input tax which has been distributed to me. That's why section 9, that's why the relevant provision, that is section 21, it says where the input service distributor distributes the credit in contravention of the provisions contained in section 20. It is not saying that where the input service, where the recipient claims more credit than what he was eligible. It says where the input service distributor distributes credit in contravention of provisions contained in section 20, resulting in excess distribution of credit to one or more recipients of credit. Excess credit so distributed shall be recovered from the recipient along with interest. So wherever any credit has been distributed in excess of the provisions of section 20, that would be recovered from the recipient. That would not be recovered from the input service distributor. That would be recovered from the recipients by way of section 21, not by way of section 73, 74. Because it is not a ITC wrongly availed or utilized. It is a ITC wrongly distributed. And that's why it says shall be recovered from such recipient along with interest, and the provisions of section 73 or section 74 or 74A, as the case may be, shall be mutatis mutandis apply for determination of amount to be recovered. Section 21 nowhere says that the recovery of such credit excess distributed shall be made under section 73, 74. It says that it shall be recovered under section 21 and the provisions of section 73 and 74 shall be mutatis mutandis applicable. So supposedly the recipient has availed a credit which the officer of the recipient believes that such credit of ISD was in excess of what has to be distributed. Can the proceedings be made directly against the recipient? No. First, the proceedings have to be made against the input service distributor. Then the recovery shall be made from the recipients, but the officer of the recipient cannot decide what is the correct credit that can be taken. First, it has to be determined at the level of the input service distributor. Then it has to be determined at the level of the input service distributor under section 21, applying mutatis mutandis provision of section 73, 74, but recovery to be made from the recipients, not from the input service distributor. Why section 21 is being discussed? Because since now the applicability would be wide ranging. So at present, not much of the cases were coming, but now many of the clients were waiting for registration under ISD. Assessment of ISD would be made. Assessment of the recipients would be made. The officer at the recipient level would be saying that you have claimed credit in excess of what you were eligible. So I would be making an assessment. We would be raising that you cannot make our assessment because the ISD is separately registered with another proper officer and assessment has to be made at that level. That officer would be assessing at the level of ISD. Now the demand that recovery is to be made from whom? Whether it has to be made from the ISD or from the recipient. As per section 21, it has to be made from the recipient. Mutatis mutandis applying section 73, 74 provisions, but the assessment would still be of the ISD, and that's why the assessment cannot be made at the hands of the recipient because it is the assessment of credit distributed, not assessment of credit availed or utilized. Because the credit which can be availed or utilized and under section 16 subsection 1 or 16 subsection 2, that is a credit only which pertains to the supplies which have been made to me. And in case of ISD, no supply is made to me, only credit is distributed, supply is made to the input service distributors. This is how I understand section 16.1, 16.2, and section 20 provisions of section 21. Although clarity is yet to be arrived on these provisions, and as I said at the start, the clarity would only come when the assessments would be made at the assessee level in numbers, not on a selective basis, and then various issues pertaining to ISD would be taken up at various forums. So this was all about ISD, and I have tried to cover the relevant aspects. Although the subject is a bit complicated, so I have tried to make it as simplified as possible. And if there are any queries and discussions, I would be happy to take the discussions. Just pointing out that we all are students of GST, no one is expert. So I would be taking your suggestions and we would be discussing on the issues which are pertaining to ISD. So handing over the session back to Swapnil.
Thank you, Arpit. It was a really wonderful deliberation, and it was very practical oriented deliberation, not a very theoretical deliberations. Okay, you have considered a lot of practical aspects of ISD, which I'm sure the speakers would be, very happy to hear, listen to. So I have some queries in the chat box, RPG. I'm just reading it one by one.
Yes.
Siddesh is asking, since notification is not issued to make clause 121 of Finance Act effective, and if we don't obtain IST with effective from 1st of April, whether any litigation will sustain as and when the Finance Act clause is made effective by virtue of notification subsequently.
So this amendment of section 121 of Finance Act 2025, this amendment is only pertaining to intrastate supplies on which RCM is to be paid and credit is to be distributed. For intrastate supplies, the amendment is effective from 1st of April 2025 by way of Finance Act 2024. So if your case is only pertaining to section 5.3 and 5.4, that is on interstate supplies. So yes, very well you can litigate and you can succeed. So although I have two views on this. First, we are discussing on a compliance level. So on a compliance level, if the recipients are eligible for credit, we should always take a conservative view and get the registration done. Secondly, I had a discussion on this aspect of section 121 with the revenue authorities. In that case, they gave an alternate argument that we do not need to make section 121 effective because section 121 itself says that it is effective from 1st of April 2025. So even if we are not bringing out any notification, that section is effective from 1st of April 2025. So then I put forward another contention before them. Section 108 of Finance Act 2021, which amended section 50 subsection 1 from a retrospective date. From 1st of July 2027 for 2017 for payment of tax on payment of interest on cash component only. Even though specifically the relevant section 108 of Finance Act 2021 provided that it is made effective from 1st July 2017. Still for that, notification number 39/2021 was brought in, which was made effective from 1st of January 2022. It was made effective on 1st of January 2022, but actual date was retrospectively from 1st of July 2017. Therefore, as and when, in my opinion, firstly, they have to bring a notification for section 121. Whenever they will bringing a notification, that would be a retrospective effect from 1st of April 2025. Supposedly, they bring a notification from bringing it forth on 1st of May 2025. But since section 121 contains date of 1st of April 2025, it would be effective from 1st of April 2025. Now the question comes, can a retrospective levy sustain in such case? Again, there would be a litigation. So if genuinely there are supplies to avoid litigation, we should take and start paying. If genuinely we forget to take the registration, then we can rest upon the amendment not being made, and together Rule 39(1) capital A is yet to be amended. So they might argue for 121, but they have no argument for Rule 39(1) capital A because the rules and the procedure are not yet in place for distribution of credit of IGST.
Okay, thank you. The next question is RPG from Nikita Maheshwari. Common services received in March 25, invoice received in April 25. Is ISD applicable?
So if invoices have been received in April 25, the simplest case ISD would be applicable, because ISD is connecting itself from the receipt of invoice when the credit is eligible to be distributed. It is not linking it when the service was received. So irrespective of fact, supposedly I received the service in March. Now the supplier can ideally raise an invoice within 30 days from the provision of the service. So he issues an invoice on April 25. That would be coming in my 2A. Supposedly I do not get a IEG registration. The revenue would be challenging the claim of the credit, that this credit was eligible to be availed post 1st April 2025. So you had to distribute it after 1st of April 2025. And that's why, in my opinion, we should get the registration and distribute it. See, Ramilji, I am coming both from the litigation and the compliance side.
Covering
And
both the aspects.
since we are here to discuss on the compliance side, so I will always have a conservative view. 2 years down the line, you invite me and discuss, sir, what are the litigations arising from ISG. So in that case, we will take the credit was due to be received and only the supplier raised the invoices late, so we are not eligible. But principally, as on date, it should be distributed.
Because the invoice is received in April 25. That is
Yes,
the reason.
yes.
How ISD will pay RCM? We have discussed this in your deliberation. In RCM cases, ITC will be deferred. Yes, I think ITC is being deferred in RCM cases.
See,
Because
again, what I would be doing as a head office, I would be raising an invoice. That invoice would be reported in my GSTR1. That would be auto-populated in for ISD on 12th. That would be eligible to be distributed if I file the return by 13th. So technically, I would be paying tax late, but practically, I can distribute the credit without payment of RCM. Because initially, there was a question when GST was implemented, that can credit be taken only when tax has been paid. So what they say, that even if you claim the credit, the tax is being paid and you are claiming the credit. So ideally, I would be raising invoice because I am required to report it in the same month in which the invoice has been raised. So I would be raising and transferring, reporting in my GSTR1. Technically, tax would be paid on 20th, but since the tax has been paid, I am eligible to claim the credit because it has been reported in GSTR1 by the supplier and distributed by the ISD to the recipients.
next question is from Ankit Khandelwal. Even for single bill of audit, makes the client having one or two branch liable to take ISD. This question is key.
Yes.
Even if it's a single bill, do we need to take ISD? Yes, the answer is
Yeah. Now there are questions that what if I do not take the ITC? What if I do not take the ITC? Then still I would be required to get the registration done. So if we go strictly how the statute has been written, so even if you are not taking the ITC, still you are receiving the invoice for which the credit is liable to be distributed between two entities. So technically speaking, on a strict interpretation, yes, even if one invoice is there, the ISD has to be taken.
okay. No. So there are no more questions, RPG. We have answered all the questions. Thanks a lot for your wonderful deliberation, RPG. Very practical based deliberation, I would say. Okay, thank you on the behalf of VIP.CA Association. And thank you all the speakers for taking out your valuable time and attending this webinar. So just for the information of speakers, next 1st of May, we have a speaker, CA Divya Bansalji from Delhi. She will be speaking on the reconciliation of books of accounts from the GST perspective. Thanks a lot, RPG. With your permission, I would like to end the session now.
Thank you so much.
Thanks a lot. Thanks a lot, RPG.
Thank you all. Thank you all.
Thank you all the participants.